Welcome to CEO Insights. I'm Marilyn de Guzman with investingnews.com. In this episode, we are talking about royalties, and joining me in this discussion is the founder and CEO of Silver Crown Royalties, Peter Bures. Hi, Peter.
Hi, Marilyn. Thank you very much for having me.
Yes, it's great to have you. I think we can start our conversation with just an overview of Silver Crown Royalties and, the value proposition.
Absolutely. So Silver Crown Royalties, as the name implies, is a royalty company, but we only focus on silver and no other metal. So generally that brings us into a market where silver is produced as byproduct credits. Roughly 70% of all the silver that's produced globally comes out of the ground as a byproduct of some other metal, usually copper and oftentimes gold. On a lesser scale, zinc and lead as well. So that's where we focus. We only take the silver part. We don't take an overriding royalty on the rest of the metals. That's what all the other royalty companies generally tend to do. Silver Wheaton was an exception. However, they've now trended toward gold as well. So it really puts us in a very unique position as the only silver-focused royalty company that's in the market today. In terms of the value proposition, we're still very young right now. We just went public on Thursday last week, July 25th. We're listed under SCRI on CBOE, and we only have 3 royalties right now. We're working on adding another one, which would be quite transformative in terms of how many annual ounces of silver it would contribute to our base. Right now, we're at about 30,000 ounces, give or take, with what's signed up and what's in the pipeline. And this particular transaction could add 50,000 ounces a year. So between that and what we have, that would get us to a free cash flow positive position if everything falls into place. And at that point, we can argue that we are relatively attractively priced compared to other royalty companies that are in the market right now.
You have a specific strategy for structuring your deals. Could you talk about this and how it creates a shareholder value?
Absolutely. We spent the last 25 years looking at the royalty space, and we felt that there was an ability to improve on the model somewhat, especially with a focus on protecting our investors' capital and attempting to take as much risk out of the equation as possible. Now, the only way really to do that in a mining situation is through diversification. You can de-risk a mine as much as you can, but then, you can have a political issue, or there can be an outside weather event, or any other string of issues that could happen. However, understanding that, we know that if we split our invested capital into as many buckets as possible, which is our objective, then we limit our exposure to any given mine project. So even if one falls off, it's not the end of the world for us. We've seen that happen to other royalty companies, unfortunately, so we very cautiously made the decision to conserve our capital when it comes to deploying it to any given project. That's the first step. The second step as well is that we don't give all the capital to the project up front. We give them a little bit, and then they have to effectively earn the rest through performance. So either they get permits, or they successfully complete an expansion, or some other milestone is reached by them, and for this we pay an additional sum. So we don't pay for ounces produced, but we essentially spend capital as the mine progresses through development or through production increases, etc. Another angle that we've taken, we've only done this on one transaction so far, but I think that it will resonate with exploration projects going forward, is paying for discovered ounces. Meaning that even though we already own the silver ounces in the ground, the more the company discovers that come to us, we will pay the company for those ounces. Usually it's not a lot, but it certainly is more than what the market price on a discovered ounce basis for that company is today. Exploration companies, they trade at less than $1 per ounce silver equivalent in the ground. For gold companies, it's about $20, give or take. It's not a lot. So if we pay more than that, we're essentially encouraging the company to go out and explore. So again, we reward performance while conserving our capital. The other thing that we've brought to the table is essentially the idea of getting paid back on our investment, meaning that up until this point, royalty companies generally were options in that money goes in and hopefully money comes back. the approach that we've taken is we strike contracts that specifically stipulate there's a certain amount of silver ounces that has to come to us as long as the mine is operating. So if we put the capital in and it's an operating project, our investors can expect at least a minimum base number of silver ounce payments coming back to them. So in a way, it's sort of like structuring a loan. You extend a mortgage, you're getting paid interest and principal. This is very much similar structure to that, in that at the very onset, you know exactly what your returns will look like based on a silver price assumption.
So you've made a decision to focus only on silver. Could you maybe provide our audience sort of like an insight on why you're focusing on a single element over, having a basket approach of multiple minerals?
So the reason why we focus on silver is essentially twofold. It's not necessarily that we're silver bulls. The way that we look at silver as a commodity is very much the way that we look at gold as a commodity or as copper as a commodity. There is a supply-demand growth curve that's been relatively constant for a very long time in all those metals. But the key driver for metal performance, I will argue, is not necessarily a supply-demand imbalance. It is the destruction of the purchasing power of all paper currencies. So that's all currencies on Earth over time devalue. So the prices, logically measured in those currencies, of metals have to go up. So as a wealth preservation measure, gold, silver, copper offer that benefit. Why did we decide to focus on silver as opposed to gold, as opposed to copper? Well, because silver is such a small portion of the metals market, not very many people are focused on it, meaning there's almost no competition in what we do. If a lot of other companies, if we look at the other royalty companies, they're focused on iron ore, they're focused on gold, they're focused on other metals, lithium, for instance, and a metal. But bottom line is, nobody is focused on silver. We did have, and I mentioned Silver Wheaton, they were focused on silver at the very beginning, but because the market is so small, to make any meaningful additions, any meaningful deployments of capital, they had to switch to more significant metals like gold. There are others like copper as well. So silver economically only makes up about 5% of mined product that comes out of the ground. If you look at a typical polymetallic mine, a copper, gold, silver, lead, zinc producer, it's about 45% copper, 45% gold, 5% silver, and 5% lead, zinc on average around the planet. So you'll have companies focus on the bigger, more relevant metals. The silver was just kind of left behind. So we could start looking at it and picking up the silver that other companies were not competing for. Going forward, I'm often asked, is there going to be competition in your space now that it's been uncovered and it's out there and it's fairly open? I don't think that there will be much competition in this space because, again, the economic impact is so irrelevant to the mine that if they try to fund the project, they have to give up more than what the silver content is, meaning they have to give up some of the gold, they have to give up some of the copper. You see that with forward sales agreements on copper concentrates. You see that with royalties on the gold side. But there's just not enough silver to move the needle for them. So these other big capital providers, they will focus on the more relevant metals. We don't see ourselves so much as a capital provider as we see ourselves as a value creator, meaning that the silver in the hands of the producer is valued the same as gold and all the other metals that they produce. If we can provide a premium to market and exposure to us as a royalty company to that project, then we offer diversification, we offer growth, all the various things that you would want a company to have that is building another mine. This is essentially doing the exact same thing, except you don't have to wait 10 years to put it into production. You don't have to go through the permitting headaches, engineering, et cetera, et cetera. It basically is like acquiring another mine operating.
Yeah, that was actually gonna be a question for you. Like if you're talking to an investor, when they're considering investing in silver, what are the benefits of them investing in a royalty company such as yours versus like a silver mining company or an exploration company?
So outside of the fact that there is no such thing as a pure silver mining company, again, because geology is the way it is, all silver comes out with something else. So you will have projects that are 70% silver, 80% silver, but usually they're 30%, 20%, 5% silver. So investing in these projects and the key differentiating factors, again, 100% pure silver, silver plus other metals, but that's not the key thing. The key thing is that our costs are essentially set at what they are in terms of overhead, and that's it. As we grow, those costs don't really change. With a mining company, well, you have production costs, and those production costs, unfortunately, are linked to the exact same currency movements, meaning that if you have revenues going up because you're a gold or silver producer, well, your costs are going to go up because oil prices are probably going up at the same rate, as well as consumables. And of course, now more recently, you have labor prices going up as well. So your margins are not as high. This provides more leverage for the producer, sure. However, it also provides the risk where you don't get that free cash flow or pay a dividend. Our objective is to pay a dividend as soon as we do have free cash flow. We would like to think of ourselves as a hard asset yield product that can compete with having your money in the bank, losing money slowly over time. You hold Silver Crown Royalties, and over time you get dividends. Whereas with the mining company, again, it's up to the profitability. If that margin is wide enough, they may pay a dividend. Who knows? Some companies or multi-asset companies do pay dividends, and the yields are quite nice. However, if you have a single asset company, you also run the risk of the issues that I described with just having one project. The risk is very high in terms of potential outside factors shutting the operation down, or the mine itself can have problems internally. And we've seen a number of pit wall failures. We've seen tailings dam failures. We've seen things of that nature that will shut down the project as well. So if you have only one mine, that's a very big risk for an investor. So, sleepless nights, something can happen. I mean, most recently we saw Victoria Gold and a pit wall and a tailings dam failure in the Yukon. So that's not a beneficial thing for an investor. Back to the diversification, we already have 3 royalties. We're working on another one. There are several others that we have in the pipeline. So it's not an exposure to a single asset. We try to spread the risk out as much as possible. So these are some of the key differences between investing in a mining company, especially a silver-focused, small scale, relative to a royalty.
As you mentioned earlier, you just listed on CBOE. What does this mean then for your company moving forward?
Well, it gives us a little bit of better access to capital. Raising money as a private company is extremely difficult in any conditions, and this market has certainly not been friendly. I've heard comments from others that it's the worst environment to raise money in for a royalty company that they've seen. So that's obviously not a good thing. Once you're public, your access to capital becomes a lot easier because now you have currency that's valued by the market, and you can approach investors with a liquid product that they can participate in, and they know exactly what it's worth. Valuing a company that's private is very difficult. Valuing a company that's publicly traded, easy. You know exactly where it's trading. You know exactly what it's worth. So we drove to go public because we endeavor to use our shares to acquire silver. We don't necessarily want to pay cash. We can, but we would prefer that the vendor take equity in us because they get the benefit of diversification, additional revenues, a growing company, et cetera, et cetera.
Right. So what are some of the catalysts, or what can investors look forward to in the near term?
So we just listed, we on CBOE, we are going through the process of getting exposure to the US market through the OTCQX. So we're in the process of doing that. We're in the process of listing the 2 warrant classes that we have. Hopefully that will be accomplished before the end of August, but before the end of this quarter. We also have a number of royalties that we are creating and acquiring. One of them is on a producing asset in Peru. One of them is on essentially technology and a mill type infrastructure. And there are others that are producers, mills, these types of projects. So we should have announcements around that again in Q3 and definitely in Q4 as well. So it should be a pretty busy next couple of months for us. And we're not going to slow down. We're just going to keep working through our pipeline, which generally has 10 to 15 projects in it. And we just keep going through it and, either say, okay, this looks interesting, let's go down the line on it, or this one doesn't work for us, and just cross it off the list and just keep adding more as we go.
Well, thanks, Peter, for joining me today and sharing your insights and company updates.
Thank you very much, Mary Lynn. Thank you very much for your time.
And thanks, everyone, for watching. Join us again next time for another edition of CEO Insights. If you like this video, like or leave a comment below. We'd love to hear from you. And if you haven't already done so, subscribe to our YouTube channel for more exclusive interviews and updates.